Lately, the ATO also finalized the risk guideline on cross-border related party intangible arrangements that have a feature of migration, typically from Australia to overseas, or the mischaracterization or non-recognition of Australian activities connected to intangible assets held offshore. This guideline takes effect from the 17th January this year on both existing and the new arrangements. But if your business is simple distribution or low-value service, you are lucky not to be captured. The ATO's approach to risk assessment is based on two frameworks. So framework number one assesses the risk in relation to the migration in the current year. Framework number two assesses the risk where no migration happened in the current year, but there were Australian activities connected to intangible assets held offshore. And framework table 2 affected taxpayers may also need to consider further the table 1 if the Australian activities are connected to a migration event happening in the last year. As you may expect from a PCG, the final outcome will be a color-based risk zone rating, which dictates the level of ATO's compliance actions. Although we may not have much time for a deep dive today, let's have a look at two examples which hopefully provides you a high-level feel as to where the ATO may come from. So under this arrangement, Auscol manufactures and sells goods, and Auscol also owned, managed, and controlled all the value-adding activities associated with the group existing intangibles, and received worldwide royalties under the original license agreements. Following a group decision, all the existing and the new intangibles were centralized to the foreign-based NewCo. So the original license agreements between Auscol and the related parties were terminated, and instead, NewCo started to receive the worldwide royalties. Furthermore, Auscol would provide contract R&D service to NewCo in relation to the new intangibles, and in return for a cost-based fee. And all the new intangibles developed by Auscol would be owned by NewCo. So a very clear-cut migration happening here. But other than the migration itself, there are a number of factors considered as very high risk. So NewCo is a newly established entity with very few employees, so no substance. Auscol continued to perform and manage the value-adding activities associated with the intangibles throughout the process. NewCo was also expected to qualify for concessional tax on income derived from the new intangibles. And on a very broad picture, had the migration not have occurred, Auscol would have continued to earn the worldwide royalties and would not be required to pay royalties to NewCo in relation to the new intangibles that Auscol developed. So what will the ATO do in this case? Very likely, a review or even audit is underway. Next slide, please. Unlike the last example, in here, all the group intangibles were centralized in the foreign-based OneCo. And OneCo had always owned, managed, and controlled all the value-added activities associated with the group existing intangibles. And OneCo also had many specialized staff to manage the activities as well. And on the other hand, Auscol did not involve any material value-adding activities associated with the group intangibles and paid a royalty to OneCo for the rights to exploit the group intangibles in its ordinary business operations. And one day, Auscol acquired the business assets from a third party, including the new intangibles, which complement the group's existing intangibles. And Auscol transferred the new intangibles to OneCo immediately after acquisition. And OneCo does also have the staff and infrastructure to own and manage the new intangibles. So although we see a migration happening here, it is justified that OneCo is the party having the capability and the substance to own and manage the group intangibles. So it is overall considered as low risk. Next slide, please. So in practice, intangible asset assessment is not a straightforward process, so we do encourage taxpayers to self-assess early. The ATO does expect the self-assessment to be completed before the tax return lodgement. Also, for larger taxpayers, which are required to complete the reportable tax position schedule, a new question on this topic will need to be completed. So get in touch with your international related parties to obtain the necessary written evidence to support your RTP disclosure will be important. And put in place your TP documentation. Although this PCG does not specifically address the pricing of the intangible arrangements, but all the examples set out in the PCG have specified that TP will be a focus area across all the risk levels in the event of the ATO's compliance action.